We've got a very special guest joining us on the show today. A rare voice. He doesn't really talk to us very often, but the calls have been pretty accurate. I'm talking about Ganeshram Jayaraman of Spark Capital is joining us from Chennai. Ganesh, nice to see you after a very long time. I remember your call of going overweight on pharma about a year back. And now after a year, we are seeing almost 4 or 5 fund managers having con calls on pharma in the last 1 month. It's coming out as a consensus play right now. Let me congratulate you on that call and talk to us how you were ahead of the rest on that one. What do you make of it now before we go into other parts of your hypothesis?
Good afternoon, all. Thanks, Ajay. Good speaking to you as well. Yes, we were overweight on pharma more than a year back, and it was completely counter consensus at that point in time. Like the same way we have a counter consensus view today, it is because we believe that the horizon should be longer than just the immediate visibility. That's where I think our views tend to be a little different. Like the way we are approaching today, we believe that the portfolio strategy should should not be in that defensive scam. We need to move it more towards the quality cyclicals and value stocks, which is a big departure to our preferred sectors and kind of stocks over the last 24 months or close to 30 months. From late 17, pretty much till the correction in March, for almost 2.5 years, we kept telling investors this risk, that risk, stay safe, capital protection is the priority, and we recommended a very defensive portfolio bias. We are changing that stance. We changed it a month or slightly in when the correction happened sharply in the month of March. We now think keeping the next 12-month horizon, we need to buy quality cyclicals, autos, banks, cement, discretionary consumption stocks, and we will want to play them. We still don't think it is time to play capex themes. It's not yet the time to play the energy recovery metals and the likes. But our preferred strategy is a mean reversion to activity levels sometime over the next few months. I mean, it is not predicated by our ability to say the lockdown effect will be an impact of so much to earnings or this much longer it will last. We don't know. But the way we are approaching it is, one, there is an inevitability to that ending, which is a few months, hopefully. Secondly, our ability to recover on the growth front is actually quite meaty. We believe that we have the ammunition to get growth back on track, which is where our confidence comes from. And as a result, our portfolio bias is more recovery bias, not defensive at this point in time. Keep in mind, our horizon is not a few months. We talk at least a year, and actually a stock picking is even with a longer horizon. So if it's our next month or two of uncertainty is overbearing, we can understand, but our horizon is longer. So the opportunity which markets are presenting to buy good companies at very attractive valuations in our assessment and recovery in earnings kept in mind, we think the opportunity is once a decade kind of an opportunity. That's how we are reading it.
Right. Ganesh, let's break that point up into different pieces and talk about it in detail. You're also making a point, Ganesh, that there is a lot of excess liquidity in the system. In fact, our own checks do indicate that liquidity in the system is at a decade high. Banks are sitting with a lot of money, but there is some amount of reluctance for the banks to go ahead and release that money and liquidity in the system, perhaps fear of spike in NPA cycle. You have also looked at that subject closely. Help us build on that and how critical this is for the economy and for the markets right now.
Right. See, in 2009, when the financial crisis came, our ability to recover from that was driven by both fiscal and monetary. Fiscal was in very good shape in a fiscal 8. So fiscal 9, fiscal 10, we could spend our way out of our trouble. Unfortunately, we don't have that much fiscal room today. Our fiscal deficit combined center and state plus off and on balance sheet leaves us with very little room for maneuvering. Yeah, of course, there is some room, but not as much as we had then. Where we have a lot of room is on the monetary side. Banks, as you said, are sitting on about 7 to 8 lakh crores of excess liquidity, which they are not currently spending. We believe in the next 2 months, we will see as activity levels pick up and normalcy returns, we will see a surge in credit demand, which is already latent, but banks are not lending as much. We believe a credit pickup will happen, especially on the mid corporates, SMEs, large corporates, the corporate side of things. We think retail credit will slow down and corporate SME credit will pick up. We also think agri credit will pick up. For that to happen, our assessment, which we believe is a silver bullet, is not to give a fiscal stimulus, but to do some kind of a credit guarantee, some kind of a credit enhancement, so that government, without letting the fiscal deficit go awry, can stimulate the demand in the economy. So in some form, what we are telling investors is, when the system is sitting on liquidity of this magnitude, you will always be able to find a growth avenue to moderate, to pick up. And that's where our confidence stems from. We believe that kind of a credit guarantee is advisable, given how the risk aversion on bank side is. The guarantee will address that. Fiscal is still kept, is reined in. At the same time, you keep the NPAs in check. The banking system, the banking system is something that is still flush with liquidity, and this will help them in some form.
Right. Ganesh, also talk to us about one of the calls which you are making in your latest strategy note, which is very contrarian in nature. Out of the 10 people we'll speak to on the street, 9 believe that the recovery would be slow and prolonged, and the growth will not easy to come by, and India will be difficult to revive. Though it will happen, at best some of them are saying it will be a Nike swish kind of a recovery, if not a long U-shaped. But your call is that the recovery could be relatively swifter than what most on the street are assuming. Tell us, where are you getting this confidence from, and what are the factors that you are reading which others may be not picking up right now?
For 4 or 5 points, actually. One is, as I said, the systemic liquidity is flush and risk aversion is the problem. The money which banks are parking with Reserve Bank every day, we need to find a way to get that back into the system, into the public's hands. It could be through government borrowing that and spending it, or banks lending it to their loans. So we think both can happen, and we believe that is really where either ways, which we think growth can revive faster than what the street is anticipating. The second point is, we think a rural economy will bounce faster. It is already in lot less impacted due to the lockdown vis-a-vis urban centers, where the top 15 cities and towns, or maybe you can spread it even more, those are a lot more impacted due to the density of population. Rural is a lot better. We believe rural demand will bounce faster. We are also seeing raw material prices which have come down sharply, not just Brent and its related variables, but also metals or petcoke and whole host of them, which means gross margins, EBITDA margins, cash flows can actually surprise. What is really the key point is demand revival on the top line front, which we believe banks and Reserve Bank, through its monetary actions or through the credit guarantee or credit enhancement, will be able to get growth back on track over the next, when the lockdown ends, which means our assessment is the second half of this fiscal or beginning when the monsoon ends and how demand picks up around the festive season and thereabouts, we believe that demand can surprise.
Right. Very quickly, running out of time, Ganesh, can you leave us with, say, a couple of themes or stocks? It will be wonderful, which you think could be very, very attractive right now on risk reward and should be a part of a portfolio for the next 12 to 15-month period.
Thanks. Especially corporate portfolio biased, or not just biased, but say capabilities to do corporate loans. Those we believe corporate we are seeing pricing power, growth, better terms of trade in the sense for better security. Corporate banking is actually making a comeback, possibly after a decade. Actually, autos. We will look to see quality names there. So the way we are trying to pick stocks are companies whose balance sheets are in good shape, balance sheet of the company, balance sheet of the promoter, balance sheet of the group. They are in good shape. We also looking at the cost structures, whether the cost structure of the company is more variabilized, not running a high fixed cost. So various auto names, cement names fall into it. Some discretionary consumption names fall into that. We believe that if the sector where the company operates in also has some companies which are weaker on balance sheet or costs, they will get impacted. So which means when the tide turns, they will be in a survival or a firefighting mode. These companies which we are looking at can gain market share. And if those stocks have also fallen and are trading at bottom quartile valuations based on its 5-year or more traded history, then we will want to buy them today. And mind you, all these recommendations are not because we believe the next 1 month will see things recover. No, our horizon is obviously with a 12-month base, and we believe that's where you make a kind of non-linear return horizon. Outsized return potential is obviously there because these companies are going to survive. Their cost structures are good. Their balance sheets are healthy, so they will tide these tough times. And when the tide turns, they will be the ones who will benefit most. That's how we are preparing our portfolio preference.
Ganesh, I'm tempted to ask you one last question on what could be the risk to the hypothesis. The elements which you're putting together in your investment argument, where is the weakest link, which if doesn't materialize, then probably, the entire game plan could get delayed by a couple of quarters or months? Western
world going into recession longer than what we believe, and that's the key risk, right? If we are going to see US and Europe in a deeper recession for longer, and that could prevent this from playing out the way. That is one risk. The second risk is if we start seeing some kind of the risk aversion continuing in spite of these. If will any other new risk manifest? Will banks continue to keep parking that money with Reserve Bank going into after the lockdown ends out as well? And that's something that we are keeping an eye out, especially on the retail pockets of retail credit NPA front. What I mean is retail is not really the salaried and the individual segment, which is fine actually, but really self-employed, subprime, which is basically individuals with a credit score of below 650, those segments, and also first-time credit borrowers. These pockets of retail could show NPA trouble. So it's not the retail as a whole, it's the tail which I'm referring to, which is where we believe there could be some surprises. Those could delay or they could push back this recovery for longer. That's where those are the key risks that we are watching.
Right. All right, Ganesh, always wonderful to have you on my show. Look forward to having you again sometime soon. Thank you very much, and stay safe, stay at home, and keep churning out amazing analysis and strategy notes for us to read. Thank you. Bye-bye.
Thank you. Thanks, Ajay. Good speaking to you as always.